Stock futures are rising ahead of the opening bell this morning as wary investors try to recover gains from the sell-off that has slammed Wall Street. The Dow, S&P 500, and NASDAQ all saw spikes in early trading. The moves come after the S&P drifted dangerously close to bear market territory last week, and the Dow saw its first 8-week losing streak since 1923. More major stores are releasing their quarterly sales reports this week. Some of the big names this week, including Macy's, Dollar General, and Costco. Reports are expected to show decreased sales as consumer spending responds to inflation and increased prices. And American small business owners are losing confidence in the economy. That's according to a survey conducted for the Wall Street Journal. It says that nearly 60% of small business owners expect the economy to get worse in the next year. That's up 15% from April. As the stocks continue to struggle, many people are wondering what will happen with their retirement funds that are invested in the market. Those stakes feel higher for those closer to retirement. An article from AARP titled "How to Survive a Bear Market If You're Over 50" looks at the unique challenges facing people as they near the end of their career. So John Waggoner is senior writer and editor and producer at AARP, and he wrote the article, and he's here with some news we can use. Thanks for joining us. I know every time I check in with my 401k, I've lost, several tens of thousands in a very short period of time. And I can only imagine if I was weighing retirement in the coming months, that it would weigh heavily on me. What should people considering retirement, what should they consider if they are in, a group that's close to retirement?
Well, sure. And, you can't help but look at your account and think of how much more fun you could have had with that money. But there's a couple things you can do. First of all, you have to consider your age. If you're 50 and you're still contributing to your retirement plan, you really shouldn't worry about it that much. You'll actually be buying shares cheaper with the same amount of money. And, that's a good thing. Plus, even if you're going to retire at 15, it doesn't mean that you're going to instantly spend all your money. You probably have another 20 or 30 years in retirement. So you have a long time to let that money recover. So the younger you are, the more time you have to let it recover. If you're 65 and you stopped working and you've started taking withdrawals, then you have to do some strategic thinking. The first one of which is don't sell your stocks while they're going down. If your stock is down 10% and you withdraw 5%, boom, you're down 15%. So take the money from some other pot, such as cash or bonds.
So you may have actually already answered my second question, because it was going to be, it's tempting to sort of cut your losses when you see things falling, because you're like, I don't know where the bottom is, so let me just pull out now. But you say there's a downside to this.
Well, the downside, particularly if you're taking withdrawals, is that you could hurt yourself more by taking money out of the stock market at that point if you're taking it out. And plus, for most people, you have to pay income taxes on the money you withdraw from a 401k. So that's an even bigger slice. So if you can, and if you are taking withdrawals, most people aren't 100% in stocks in their retirement accounts, nor should they be. So if you are terrified at night and you wake up screaming, I'm ruined. You need to probably cut back anyway at some point to eventually get your portfolio back to a place where you're not terrified every night.
Right. Your article also mentions having a bucket plan. Can you explain what that is?
Sure. The bucket plan basically says is that you divide your portfolio into roughly three buckets, as it were. The first bucket is for money that you're going to use now. The next is for money you're going to use in 5 to 10 years. And the next is for money you're going to use for 10 years and more. You want to use your first bucket for anything that you need to spend. So that's going to be put in cash. It's going to be safe. You're not going to earn much, but you'll know how much you have. The next you'll put in bonds, the intermediate term one. It's not as risky as stocks. Stocks are getting pounded in this bear market. They're down about half as much as the S&P 500, but again, half as much as the S&P 500. That you're going to use, and you're going to use the income from that to refill your first bucket as you use it. And the last one is stocks, and that's for, the longer term. That's for when you want to, when you're retiring, you want to come out and use it for, in 10 years, or move it into your first bucket. as it were, so that you're always kind of refilling your buckets as they go on. But the main thing is it keeps you taking money from the safest bucket and eventually refilling it with the assets from riskier buckets.
What changes should people be prepared to see with their 401ks, say, in the coming months? I don't know if you can even predict that.
I can't.
Yeah.
I can tell you that a typical bear market is going to take about 33% from your stock assets. A really big one, the biggest one we've seen since the Great Depression, was in 2006, and that took 57%. That's a big knock.
Yeah.
Because you have to remember, if you lose 50%, you have to earn 100% to get back to where you were. So there's a longer recovery time, and that would be about 3 to 5 years to get back even. It's also kind of one of those things where usually people always get tempted to buy individual stocks because they see them go up, and it's kind of a good reminder that you're better off with a portfolio of stocks, such as you get in a mutual fund. Netflix is down about 70%. That's a huge loss to take. So you want to, you want to be diversified. You want to spread your assets out and be patient. The stocks will come back, even if it's only through the dividend payments. But it takes a while.
Right. Be patient. That's probably the number one advice. John Waggoner, thank you very much.
Thank you.